Hello and welcome to the Life by Design podcast, brought to you by Strategic. This podcast is all about helping you live your great life. Each episode will feature insights from our Chief Investment Officer, Doug Walters. Hello and welcome back to Life by Design podcast. Again, Doug Walters is joining me. Hello, Doug.
Hello, Jay.
And we're going to do our weekly insights at the top here, and then we're going to talk about the art of doing nothing today.
One of my favorite topics.
Perfect. Yeah, some of my cats too. Let's start with our kind of like the week so far and what we're looking at ahead.
Yeah. So it's an interesting week if we look back over the last 7 days, because I've been saying probably on just about every one of these podcasts, there's three things that seem to matter right now: tariffs, the Fed, and inflation.
Mm-hmm.
And we had a bit of all three of those in the last week. So last week we had the Fed that left rates on hold, kind of a non-event. It was what was expected. However, over the weekend and on Monday, the tariff announcements were out that going to put tariffs on hold with China for 90 days. That was a big market moment, big market rally on Monday. Today in the morning, we had CPI inflation data, which came in a little bit more benign than expected. So kind of the trifecta of data coming in, but the big one that really moved the markets, of course, was the tariffs. It's what the market has been pinning most of its price movements on the last few weeks.
Yeah, and it's, I know we have talked about this, I think, every podcast for the last several weeks, at least for a moment of it. And, I think this leads into our next topic, which is the art of doing nothing, which, we need to be able to zoom out from these moments and from the relentless news coverage of these moments and ups and downs. Like, that's what the market does day to day.
Right.
Second to second, ups and downs. And, I know I've heard it here a lot, but just encouraging folks to pull themselves maybe a little bit higher into like the 10,000 mile view of this over years or 5 years, 10 years, and like looking at the market that way. Yeah,
it is. It's one thing to say that these tariff discussions are driving the market. It is another to say, somehow I know where these discussions are going to go. You just don't. You can see how big of an impact they have, but it's just not something that's in our control. Within our portfolios, we need to control what we can. We need to be prepared for moments like this, but we can't predict them. We had some good news on tariffs this week. It could be bad news next week. We just don't know. Yeah. So we want to be ready for all of those moments.
Yeah, and I think it's great, and it kind of leads to our next topic, Doug, which is the art of doing nothing.
Yes.
And that's where we cut the podcast. But so kind of explain maybe a little of the background of this idea for you and where it comes from and why you're thinking about this right now.
Right. And I want to distinguish it from being patient to some degree. It's related, right? Being patient in these moments, letting the market do what it's going to do, control what you can. But there's a difference between being patient and doing nothing. So that's kind of like what I'd like to touch on today. And this idea came to me as I was sitting, I was at the CFA Live conference in Chicago this past week, which for those of you that don't know, CFA stands for Chartered Financial Analyst. It's kind of the pinnacle of designation for us financial individuals. And this was a conference where we all get together and talk about topics of the day. And there was one of the presenters up there. He was talking about his investment process, analysis process. And he said, the hardest thing is you spend all day, all week, several weeks analyzing the market, diving into the economics, looking at all this data, trying to take what you're talking about, all those moving parts, and distill it into an opinion. And more often than not, the conclusion is the best thing to do is nothing. And that is very hard. And it's hard because of what we've talked about in the past, action bias, story of the goalies that always have to jump, side to side. So it is, always feels like, we should be doing something, but more often than not, the reality is we should not. And that's what I'm trying to sort of put out in insights this week.
Yeah. And I'm trying to think of an example that doesn't get too deep into the waters, but it would be, if a certain stock that you're in is going down that a little bit, that maybe you may want to just wait and see because it could rebound based on other news or something else like that. Like, is that kind of like a weird example, I guess, but not. Yeah. I'm trying to equate it to something
it's not a weird example at all. And that really ties into how we think about rebalancing. A stock has to move a lot for it to be a moment, for it to be an actionable moment where you can say something has really dislocated here.
Okay.
And we want to take advantage of that. Either, all right, we totally got this wrong, we need to cut ties here, or there is an opportunity. This stock has fallen, 30% on news that, we feel like was already out there. The investment thesis hasn't changed. Stock is now 30% cheaper. Now is the time to take action. And those moments, especially if you're not thinking, about an individual stock, but you're thinking about the market as a whole, those moments are few and far between. So yes, you need to be on top of it, analyzing the data, understanding what's driving the markets, watching the moves, but not taking that action, having the discipline not to take action too soon.
Yeah, and so it's funny, before we started recording, I was just like racking my brain to come up with an analogy so that I could understand this a little bit better. And I think I got it.
Okay.
And I'm going to do it live and we're going to see if it works. But it just struck me as you said that like I'm thinking about with my kids, right? Like if they sneeze, it doesn't necessarily mean they have a cold or that they're sick or that there's something else wrong. It could just be that they just sneezed.
Right.
And I don't need to start loading them with medicine or taking them to the doctor or doing something drastic.
Right.
I can just be patient and I can wait and see what happens.
Right.
See if they sneeze again or if they have a temperature or the other ailments that would then line up with them having a cold. But in reality, I have to be patient and do nothing until some more symptoms arise.
Right. Yeah. And when we talk about doing nothing, we're talking about the specific action of changing something, right? So you were clearly doing something. You're going to watch their temperature. You're going to, you're going to take in all of the data. And it's when that data tells you, oh, yes, I need to go, we need to take this child to the doctor now. That's the action. But until then, the right move is no action.
Yeah.
And again, most of the time, and a good analogy, because most of the time your kids are not sick, hopefully.
Right.
And then so, you were just monitoring, but not doing anything. Yeah.
Yeah. And so when you kind of think of this day to day, what do you think is the hardest thing for people? Or I'm trying to think of like what would really trigger them into wanting to make an action that maybe it's more of a wait and see scenario for them.
Right. I think, when we see headlines with the market moving, there is a sense that, something needs to be done. And, oftentimes I think we have very good open communication with our client base. They're well educated. They understand generally that if markets are falling, that tends to be an opportunity to buy as opposed to sell. So more often than not, we're having to have those conversations that, a decline of 5%, a decline of 10% isn't one of these moments. The 10% decline seems like a lot, but you're likely looking at a market that had generally been going up. Let's take our 2024 as our example. Market rising, had been rising for 2 years. We come into this year and we get that 10% sell off. For some, I'm sure it felt like a moment. Should we be taking advantage of this? No, that's just normal volatility. We're looking at the data. That is not that moment you're looking for. Maybe we were, maybe the market had sort of had overshot on the upside a little bit, and it's just paring that back,
recalibrating.
Right. Then then it came down another 10%. We saw that 20% decline. That's probably more around the time you're thinking, all right, maybe there's an opportunity here. It wasn't thinking specifically to this year. It wasn't a huge opportunity, again, because the market had risen so much in the previous 2 years. We were coming from a moment of like a very expensive market, but 20% down is a decent decline, and certainly our rebalancing was going to want to take advantage of some of those cheaper assets.
So and I know we've kind of talked about this before, but it's interesting because the more I think about it, the more we talk about it, right? We always talk about the market as like this nebulous creature of its own, right? Like, but in reality, it's folks like our listeners, it's folks like you and I who are getting the same, just about the same news and information and reacting to it. Or in some of the cases where you say, oh, it was built into the market already, that means that maybe they saw it coming down, or like news of it that, oh, hey, in the next 60 days, we're going to look at tariffs as an example. Well, that gets built into the market because they're already thinking about that 60 days ahead. Is that so? So I just was thinking about like, it's just people.
Yes.
Right? Like reacting to the news of the day or the news of the month or week, and then acting on it.
Right. Yeah. It's that is a great point. And it is, I do have to catch myself writing insights, talking about the market. We are talking about investors. We are talking about people. And this may not have been where you expected this conversation to go, but there are, kind of two very main trains of thought when you think about the market and investors. And there are those that see the market as perfectly efficient. Whatever information is out there is being consumed by all of these investors. It is reflected in the pricing, and at any given point in time, the market is perfectly priced for the information that is available to us. And then there were those that believe that, yes, but we have behavioral biases and we don't always act rationally. And sometimes we overshoot or undershoot, or even, it could be quantitative, high frequency trading driving markets to irrational levels. So there are two trains of thought. We tend to lean more towards that space where there are behavioral biases and we do see the market overshoot and undershoot, and we want to take advantage of those opportunities. Yeah.
And it's just, it's interesting to think about it sometimes, because I just, it's just a bunch of people making decisions that are moving things in different directions. Right. And like, to bring it back to that podcast, couple podcasts ago, with the like collectibles, right? Like the value is inherently what it was sold for, what it was made for, but the value then comes from people like me who love Star Wars and go, oh, I want that Luke really bad. And and driving up the price and go, it's worth $2,000. So
yes. And you think about cryptocurrency. Why is it worth anything? Well, it is worth something as long as people attribute value to it.
Right.
As soon as they stop, then it's worth nothing. The difference with, say, cryptocurrency and investments, where you are investing in a company, stocks, you are investing in future cash flow.
Yeah.
Right. In the end, investors are constantly and consistently trying to determine at the company level, what is their future cash flow going to be, and what am I as an investor going to get because of that?
Right.
And that is, the difference between, stocks and bonds and certainly cryptocurrency and perhaps your, Star Wars figures. I don't think they're producing, shooting off, dividends.
Right. So I guess that for like stocks and bonds, it'd be more of thinking of it like a a player for any type of sports, right? Like a baseball player, right? So when a team wants to sign a player for a contract, they're signing the contract based on future, what they think that player's potential future is going to be.
Right.
And what they've seen, what that player's been capable of thus far, and what they think they can do for the team. Moneyball withstanding.
Yes.
but that's it, you know. So yeah, that's an interesting. I was just thinking about that. So it's like, okay, so we know this company has done this to this date. We know that they have, a pipeline coming of all these cool, let's say, technologies. If we're going to use a technology company, so we think they'll be worth this in the future. So we want to invest in that to be part of that growth.
Right. And let's bring that back to the tariff discussions where we started. When you get an announcement like, tariffs are on hold for the next 90 days, why did the market jump up? The market is interpreting that as better future cash flows for all of these companies,
right?
Our companies on average. So inherent in that, presumably, is some assumption that after 90 days, something, continue, that those tariffs are going to continue to be lightened from where we were last week.
It continues to go in a positive trend.
But ultimately, all of those investors are trying to determine the impact on future cash flow of these companies, of these economic changes, be it tariffs or the Fed raising or lowering interest rates. It's all about future corporate cash flow when it comes to stocks.
Yeah, it's just wild how many different ways you have to think of it to try to explain it to myself. I go, oh yeah. But yeah, okay. So I know we started on the art of doing nothing and we deep dived a little bit into it. But basically at the end of the day, you want the people at home who are listening this to think about this in a way of thoughtful actions.
Right. Yeah, it is. There is a lot of action happening behind the scenes, analyzing the impact of tariffs, analyzing economic data coming out, looking at where there may or may not be opportunities within the various asset classes. And often that leads to decision, we're good right where we are, right? Things economically don't move that dramatically. Yes, a tariff announcement can move things big on one day, but we're looking at much bigger, longer term levers than, a 90-day pause in tariffs.
Yeah. And
so we need to see something much larger than that to decide that, yes, there is an action that needs to be taken. And it's related to patience. Historically, we've talked about patience just being, tuning out the noise and avoiding headline and just sticking the course with your investment process. Here, I'm talking about like actual decisions within the portfolio. That requires patience as well. And it requires, and often means we're not taking action week to week.
So finally, a positive spin on I'm doing nothing.
Yes. I like that.
Yeah. All right. Well, thanks, Doug. Really appreciate it.
All right. Thanks, Jay.
This podcast is for educational and informational purposes only. Please see the full disclosure in our show notes for more information.